Ladies and gentlemen, welcome back today to a video that I think you'll find somewhat interesting, especially if you have an interest in macroeconomics, finance, or simply if you just have savings in the bank. You definitely want to watch this video. Now, just another point before we go into it, this today and tomorrow's walk and talk will be my last video for a couple of weeks. I just need to take a little bit of time off just to relax a little bit, recuperate. And yes, a lot of you keep commenting saying, Neil, you're not looking good at the moment. You got big bags and all sorts. I just need a little bit of a rest. So I'm going to be taking a week or two off from after tomorrow's video. All right, so with that said, let's get into the reports then. Okay, so we're going to be looking at two very important reports today. The first one is from the World Bank. So it doesn't really get much bigger than this. World Bank, BIS, IMF, these are your three big ones, but I would say the World Bank is the biggest. Now we're going to start here on page 103. And what I want you to notice here is this report is all about dealing with, and you can see at the bottom here, resolving bank asset distress. So they're talking about, and it's very interesting and timely at the moment, that all of these organizations are putting out these reports. Now, what is one of the things that they are listing here as how a bank can deal with financial crisis, or if the bank thinks that it's going to have a liquidity crisis or it could collapse, it can't repay its creditors, what are the options? Well, again, we've talked about this a lot. You can see here, bail in. The resolution authority has the power to write down and convert loss-absorbing liabilities of the bank in resolution into equity. So let me just explain what that means in simple English. Loss-absorbing liabilities in the bank. What does that mean? We've talked about this a lot, where I've said, well, usually when one of you asks me, is a bank safe? I've said, well, do they give out mortgages? Do they give out business loans? Do they do some sort of credit and credit cards and the like? If the answer is yes, then there's always a risk with that bank. And the more they lend out, especially if the reserve ratio is pretty much zero for a lot of banks, especially USA banks, where the Fed actually reserved that ratio down to 0%, that means they don't need to keep anything in the vaults, as it were, even though it's not money in the vault anymore. So they don't have to keep any reserves. So you imagine then that your bank, and again, this is very unlikely, okay? But let's just say they have zero reserve. They've lent out everything that's come in from depositors like you and I, where we've put savings in the bank. Let's just pretend that they lent all of it out on mortgages and businesses and the like. Well, what's happening at the moment is we're now going into this recession. As we go into this recession and interest rates rise and we have quantitative tightening, i.e. the destruction of capital, what is going to happen is you're going to see a lot of defaults. Now, it's going to ripple through the economy as we have employment scarring. So you're going to see people defaulting on credit cards, loans, auto loans, business loans, mortgages. All of these things are going to start to default. Now, at the same time, if you have a run on the banks, which pretty much happens every time, this is why they're closing so many bank branches and ATMs. That way you can't do a run on the bank. If it's very digital, how can you go and take cash out of the bank? So you see where this is going. So what are these loss-absorbing liabilities they're referring to then? Most people think that the liability is the debt, but actually that's not correct. That is an asset for the bank. So when they lend out a mortgage, that to them is an asset because they're making a return on that mortgage. Now, you may think the asset would be your savings in the bank for them. No, to them, that is the liability. I know it sounds very unusual and counterintuitive to what you'd think, but that is the liability. Your savings with them is the liability. So what are they saying here then in this? Let me load it up again so you can see the statement. The resolution authority has the power to write down and convert loss-absorbing liabilities of the bank in resolution into equity. Now, I'm actually going to show you what that means now as we go down to page 104 of this report. So these are bank resolution tools. Okay, so you've got these 4 resolutions. Well, what is number 3 and 4 on this list? It is bail-in. So what does that mean? It means write down and convert the loss-absorbing liabilities of the bank in resolution into equity. Restore the balance sheet and maintain bank continuity. For large and complex banks, avoid the cost and execution risk of P&A and bridge banks. Okay, and then we have enabling legal powers. Remember that this is now law. Even though it should be illegal, it is actually legal because they passed a law. Bank has sufficient loss absorbing capacity for confidence to be sustained. Now this is another crucial thing. We haven't talked about it a lot before, but this is liquidation. So part G here. So what are their options? Liquidate part or all of a bank's book. What does that mean then? The book is what we would call the assets. So they may, and you probably saw this a lot in 2008, they may sell these assets onto other banks, for example. There is a lot of options here. But next, pay out insured depositors if not transferred to another bank under the P&A. So this means your FDIC or whatever country you're in, this means your sort of insurance scheme, which I do think would pay out on several small banks actually going into administration. I do think it would pay out. But here's the question. What happens if you don't just have 2 or 3 small banks, or even if they're medium-sized banks going into liquidation or bankruptcy? What if some very, very large banks have a liquidity crisis, or dozens and dozens or even 100 different banks have a liquidity crisis? Is the FDIC going to be able to pay that out? I would say no, because the money isn't there in the account anyway. It is an insurance program. So they would probably print more currency and then sell bonds or something like that in order to pay out all of the people, you and I, who have savings in the bank. Now, let me give you a couple of examples here from this report for those of you who are skeptical and think, oh, this would never happen. Well, we have examples at part E here. Bank of Cyprus, 2013. We have this bank in Portugal here in 2014. And then we have a Spanish bank in 2017. So this actually has happened 3 times here. You can see it. And then we have Penn Square Bank in 1982. And this is an example where all of these measures failed to actually stave off a banking crisis when the bank went into administration. And I'm actually going to show you that in a moment, but I just want to finish on this paragraph here. Open bank bail-in strategies, for example, may prove difficult to execute because of the general lack of loss-absorbing financial instruments that can be bailed in, coupled with the difficulty of issuing eligible liabilities at times of high market volatility. Uninsured deposits are then the only, this is your money in the bank. Uninsured deposits, because that's what they treat your savings as, are then the only feasible liability class that can be bailed in, which is politically unpopular and can jeopardize depositor and market confidence. Now, if you remember, I did the Great Depression diary series, and part 2 was all about the banks, and it was a very, I guess we can say, moral system back there. There was a lot more integrity than there is today. And even in that period, if you remember those diary series, we talked about how even the man's friend down the road, the bank manager, said, no worries, no need to rush to the bank, come on Monday, everything will be fine. And he turns up on Monday and the bank has closed its doors forever. But let's go over to the shared screen a moment here once more, because I do want to actually show you what happened here. The Bank of the United States, a private bank with no actual government status, collapses in what was the largest bank failure in US history at the time, freezing some $200 million in depositors' funds. Prices are falling rapidly, and the dollar buys you a lot more today than it did a couple of years ago. The problem is there is no money in circulation. And if you've been following along, I know a lot of you have been commenting saying, Neil, I just watched that series over again for the 3rd or 4th time, because it's amazing how much of that is now coming true. All sorts of things, even from the farming aspect, which 2 years ago when I made that series, that hadn't played out yet. But now we're starting to see the destruction of livestock and crops, and farmers being paid to stop farming and all sorts of things. Some of these things, yes, okay, it was a little bit delayed, but these are now starting to pass. Now, I want to go back and show you one other thing on this. Now, one of those examples was this failing Spanish bank. So let's read this. It's the first time that a failing bank has been rescued under new rules designed to keep European taxpayers from having to bail out failing lenders. So this is bail-in. Actually, this statement isn't correct. Who's this article from? So CNN Business. This statement isn't actually correct because we already had a bail-in in 2013. So you can see the date here. So the Spanish one wasn't actually the first. So this was when Bank of Cyprus depositors lost almost half of their savings. Depositors will lose 47.5% of their savings. Depositors taking losses will get shares, or should we say worthless shares, in the bank. The losses are estimated at around 4 billion euros. So what happened? This was Nicosia, Cyprus. Depositors that bailed out Cyprus' largest bank. Okay, key word here, Cyprus's largest bank will lose 47.5% of their savings, exceeding 100,000 euros. So $132,000, the government said on Monday. Who else was involved in this? As usual, the IMF. The savings raid prompted Cyprus authorities to impose restrictions on money withdrawals and transfers for all banks to head off a run. Now again, this is why reading history, even though this is only 9 years old, is so important, because we now know some of the sort of markers and events that took place before the actual bail-in occurred. What was that then? It was restrictions on money withdrawals and transfers. So we need to keep an eye out for this. When you see a lot of money withdrawals being restricted and transfers, this is when you know there could be an issue. As part of the bail-in of Bank of Cyprus, depositors taking losses estimated at roughly 4 billion euros will get useless shares in the bank, because they're worthless. Now this is the other one I wanted to show you. This was the Penn Square Bank, probably one of the biggest examples in history. Now this was the failure of the Penn Square Bank of Oklahoma City had a devastating effect on the US banking system when it was declared insolvent on the 5th of July 1982. The bank made loans and then sold shares in the loans to other banks. This is also what's going on right now. As payments came in, Penn Square charged a fee to divide up the funds among the banks according to their share of participation. This allowed them to generate $2 billion worth of these investments. So what happened then? Well, by the late 1970s, the Federal Office of the Controller of the Currency Examinations indicated that Penn Square Bank was overextended. Now, another key thing to look at, when oil prices dropped in 81, the situation quickly turned desperate. Depositors withdrew $50 million in May of 82, and by July, examiners knew the bank could not survive. They spent the 4th of July weekend, what a surprise, it's always a sort of weekend bank holiday, setting up the closure of Penn Square. And by the way, that's another one to look out for. Whenever they have these special bank holidays and, we're taking a holiday today, that is another red flag. So they spent this 4th of July weekend arranging the closure, forming a new bank so that the FDIC could pay the $207 million that was due to uninsured depositors. Uninsured depositors of $163 million were not paid. Now, if we look at what happened after this, it actually had a knock-on effect. So the Seattle First National Bank in Washington was one of the first failures to result from losses on the participations in those investments. Soon after, Continental Illinois National Bank and Trust Company in Chicago, which had participated in the loans in the amount of almost $1 billion, became the largest bank failure in US history up to that time. Now, this is the Bank of England Stability Report, and actually it's somewhat of a global perspective, mainly talks about the UK, but there's some very interesting things in here. And I said the other week I'd need a couple of hours to read through it. I've gone through it, and we're going to actually look at a couple of points now then. And I've actually highlighted this on the shared screen for you as well, just so you can read through as we go. And I will put the link to these two reports here in the description below, just so that for those of you who have an interest in reading it, you can actually go over this. So this is page 4 then. And it says the economic outlook for the UK and globally, okay, key here is globally, has deteriorated materially. And of course, just like all central banks, they are blaming it on Russia, even though that the inflation actually started a long time before Russia invaded Ukraine. However, there is some truth in that some of the inflation that's coming through now is as a result of energy, commodity issues as a result of that conflict. There is truth there. But is all of this inflation from Russia and Ukraine? Absolutely not. There's just no possible way, because inflation is an expansion of the monetary supply. But yes, there are some aspects of it that are affecting inflation now. So we also have further disruption of supply chains, which is also playing into the inflationary spiral. Central banks across the world have tightened monetary policy. This will result in negative shocks to the global economy. And we also have risks of more persistent, elevated inflation and increasing credit risk. You see how this is all linking together now. So what will these inflationary pressures actually lead to? Weaker economic growth globally, a further sharp tightening in global financial conditions. So this is the destruction of finance, credit, lending, liquidity, etc. The potential for further volatility and stress in financial markets. But most importantly, what will affect you is tighter conditions would increase the pressures already facing households and businesses and the serviceability of public sector debt in some countries, including, key one here, the euro area. What were we just talking about last week? We also have risks in China around the re-emergence of vulnerabilities in the property sector and potential restrictions to contain further COVID outbreaks. Now, what they mean by this is that if China starts doing more restrictions, you will have the breakdown or the further breakdown of globalization. Those who are typically more likely to experience repayment difficulties is not expected to increase substantially this year, in part because debt serviceability will be cushioned in the near term by fiscal support measures. Now, this is very interesting because we haven't heard anything about any of these fiscal measures coming out yet. So maybe the BOE are just a little ahead of the time here in putting this out, whereas the government's probably saving this as somewhat of a wild card to get them out of some more problems that might be coming down the line. But I do think it's interesting they're saying that repayment issues are not expected to increase substantially this year because we've already seen it increasing this year. Now, maybe substantial is the word that we can argue over here, but we're already seeing payment difficulties actually increasing. We're seeing debt levels rising sharply, and we're seeing the savings rate drop sharply. But then they go on to saying that this share is expected to increase above its historical average in 2023. So they're basically saying, okay, this year we don't see a major issue, but next year, 2023, this will increase. Now, I've highlighted this in pink here because it says, as interest rate rises continue to pass through to households and unemployment rises. Where have you heard anything about unemployment rises? They haven't. They've kept it very quiet. And again here, as interest rate rises continue to pass through to households. So that is things like as the base rate goes up, mortgage rates will go up, credit card debt will go up, the interest on it, etc. Now, it's a little bit different for countries outside of the USA. Remember, in the USA, you can get 20, 30-year fixed rates. But in UK in particular, you cannot. On average, anywhere from 2 to 5 years is all you can get a mortgage fixed for. So at the end of this period, we're going to see a lot of people really struggling in the housing market. Now, what else? We've got a clue here as to what sectors will suffer the worst, the fastest. The fall in household real incomes could reduce demand significantly in sectors such as non-essential household goods. So if you work in this sort of field where it's non-essential household goods and services, then they are saying that these are the areas that are going to struggle first and foremost. Again, I've talked about this many, many times with my, examples about your unicorn frappuccino and going for your ice cream with the gold sprinkles. All of this sort of stuff is going to drop Now, probably the most important paragraph of this entire document is right here that I want to read out to you, because even though it says UK, this actually applies to most countries. Because what did they do? They destroyed the small businesses. So UK small and medium-sized enterprises, SMEs, have more debt than prior to the pandemic, although the vast majority of this new debt was issued at relatively low rates, and the majority was fixed for 6 years or longer. Despite this, at least 70% of the current stock of outstanding SME debt is estimated to have been issued outside government loan schemes. Now that is really worrying. And a large proportion of this debt is exposed to bank rate increases within a year. In other words, you're going to see a lot more collapses and bankruptcies of SMEs. SME cash buffers are also lower than during the pandemic. SMEs make up a relatively small share of total corporate debt and therefore pose limited direct risk to the UK financial sector in terms of bank losses, but represent a much larger share of employment. Yeah, again, I don't agree. They are focusing very, very narrowly here on themselves in terms of the financial sector. But what they are missing is employment scarring, for one. They're also missing the fact that, yes, it's a larger share of employment. Actually, it's a huge share of employment is through SMEs. And it varies from country to country. But in the most developed, it could be 50% of all employees operate within SMEs. In undeveloped countries, it can be as high as 95%. So they're really not giving this the correct emphasis that they should be. This could be absolutely catastrophic. Again, we have this paragraph talking about spillovers. So if you remember what happened with the United States back in the '08 crisis, the US actually spilled over their debt crisis into other countries. We also have debt vulnerabilities here in China remained elevated, particularly in the property market. We've covered that on previous videos about Evergrande and some of the other sectors and how they could collapse. And then we have, for once, an honest, well, somewhat honest report here showing that inflation is expected to reach slightly over 11% towards the end of this year, 2022, weighing on real household income. Yeah, and I would agree with that. Although I would say if you measure it by the 1970s, 80s, you're really at over 20% inflation this year. That means 20% of your savings destroyed just in 1 year. Now let's look at this then. This is talking about the amount of income spent on taxes, and such essential spending varies greatly across the income distribution. For households in the lowest income, it accounts for 90% of their income. I'm not even going to talk about the other bits because this is the crucial bit. 90% of household income. Now, what is going to happen once this starts to accelerate? This is going to be an absolute nightmare for most households. Okay, so let's finish up on page 28 then. And this is a real scandal in my opinion. SMEs now have a much higher level of debt than before the pandemic. Over the course of the pandemic, they acquired substantially more debt, while larger businesses' outstanding debt was broadly flat. Total outstanding SME debt increased by over 20% between the end of 2019 and the end of 2021. However, the vast majority of new SME debt was issued at relatively low interest rates via government guaranteed loan schemes. Well, they just said that, I mean, this makes no sense. They just said that around 70% of it was outside of that. And now they're saying the vast majority of it was here. So there's a lot of conflicts that I've found as I've gone through this report. I mean, it seems pretty obvious that different people have been writing it and they've put it all together. But the thing I think is most worrying about this is that if you look at what happened to the SMEs, the small, medium-sized businesses, as it were, and then you look at what happened with the big corporate, what is the difference here? Well, the SMEs didn't get any grants and free money, as it were. A lot of these big companies, the government said they're too big to fail. So they just gave them money. They don't have to pay it back. They gave them these grants. They gave them all of this money. And that was to protect employment. Well, that makes no sense because the SMEs actually employ more people than these big corporates. So what's going on there? I think you know. But what's happened is these SMEs have now taken on so much debt, and now interest rates are going up. They are not going to be able to service a lot of this debt. If this report is correct, they're saying 70% of this debt that got loaded up was outside of fixed terms. That means it's on variable rates in some regards for some of that debt. We don't know exactly how much. It's not here. And again, I've gone through with my ridiculously oversized calculator here, crunched a lot of the numbers, gone through the banks, gone through the global reports, all the macro, and it is not looking good. Let me just say that. It is not looking good at all. And I just don't know how this is going to go. It's getting more and more complex by the day. I definitely think we've got risk of bail-in. I definitely think we've got even greater risk of more small businesses, medium-sized businesses collapsing. And I definitely think that we're going to be going into a recession, as well as high levels of unemployment. Once the economic crisis, I guess, takes this second peg down, once we go down into this next level, we are going to see this play out a lot more, and unemployment will then start to rise. As unemployment starts to rise, you're going to see a lot of issues, because spending into the economy is going to drop off a cliff. This will result in more bankruptcies, small businesses having less money coming into them. And then as this goes through, what do we talk about? Let's bring this back to the start then. As these businesses are starting to go bankrupt, where do they get their money from? Banks. What happens as people can't pay their mortgages? Where do they get the mortgage from? Banks. What about auto loans, credit cards? Banks. So you see how all of this is coming back together to connect. However you look at this, you are going to be affected. It's absolute certainty. Whether you've got stocks, whether you own houses, maybe you're a landlord, maybe you own one house, your family home, and you've got it on a mortgage, whether you're employed, whether you're a spender into the economy, everyone is going to be affected by this. No one is going to get away from this. All of this is going to be coming down the line, and I believe we're already in it right now. I believe the last 6 months, almost 7 months as it were, we have been in a recession already. We just don't know it yet because the numbers haven't caught up. But we are very, very close. We're very close to all the numbers catching up now. Everyone realizing that we're in a very bad situation right here. So what I would say to you, as I just drink my tea for a moment, is that we are in a very bad situation now. If you've got money in the bank, you've got savings, you've got lots of different assets, or maybe you don't have assets, maybe you've got a job, maybe you're worried about your job, I would spend some time at the moment just really thinking through all of this, what I've said in this video here. Have a read of these reports if you're that way inclined, and just make sure that you start to think about these things and have a plan around it. If you're not in the private community on Patreon, the link is below, always in the description to all my videos. You can actually go through there, have a look at it, see what you think. You're more than welcome to join. I've got a video on there that explains all the different tiers. And I honestly do prepare everyone. I post in the Patreon, which is the private community, regularly. I make a monthly video. I explain all the things that are going on. I explain how to protect yourself. I mean, everything is covered in there. If you've got questions, you can ask me a question. But overall, regardless of whether you join the community or not, just make sure that you do something. Start preparing for all of these things coming down the line, especially if we have some sort of banking failures and there's bail-ins and things. If you've worked your whole life for your life savings, what you've got saved up, don't allow these banks to just steal your money, which is what would happen. And it's pretty clear that is what's going to happen, because they just put out this new report. The World Bank has just put out this new report for all the other central banks to look at, to follow. If your leader, the leadership is saying, do these measures, why would you not do them? Regardless of whether you think there's integrity behind it or not, these other banks are just going to follow what the World Bank has told them to do here. So no, it's not a good situation. Please prepare for this. And yeah, it's just not good. I don't know what else to say on it. It's not looking good at all. I am worried, I'll be honest. I am worried about what's going to come down the line. But all we can do is prepare as best we can. Keep riding through this storm. I'll continue to do what I do for you and what I can. And I'll continue in the private community to post regularly as to what's happening with bail-ins, how to avoid some of these bail-ins, how to diversify assets and the like, just so you're not too badly affected. All right, well, thanks so much for watching. A bit of a longer video today, I know, but I appreciate you, and I'll see you for the last video for a couple of weeks, which will be tomorrow, the walk and talk. Take care. God bless.